$2.2 million tax-free. That's what each of my children would have in their Roth IRA by the time they retire at age 65. I mean, it's not quite the $5 billion that Peter Thiel has in his Roth IRA, but then again, he bought 1.7 million shares of PayPal in 1999 for a tenth of a penny. Maybe my kids will get lucky as well. But if not, they'd have to start contributing at age 18 with income from those first summer and part-time jobs. They'd have to put in the maximum amount that's legally allowed right now. That's $6,000 per year. And they'd have to do this every year until they turn 65. $6,000 per year, that's $500 per month, or $16.44 per day. $16.44. I'm not nuts. I don't run these calculations randomly for fun. At least not all the time. The IRS recently released the Roth IRA and 401k contribution limits for 2022, which is what we'll be getting into shortly. And it just got me thinking, how easy or how hard is it to retire a millionaire if you start early enough? And even more important, what happens if you start too late? Is there such a thing as too late? And do you still have time to contribute for 2021? We'll answer all these questions in the first half of this video. If you're interested in just those 2022 IRA and 401k limits, then feel free to skip ahead to the second half of this video. Timestamps are below as always. If on the other hand, you're thinking, 18 passed me by last year, or perhaps years ago, can I still become a Roth millionaire? Can I be a Roth millionaire if I start at age 20, 25, and beyond? And the answer is yes, in some cases. And in the cases where you can't, there is still so much you can do to build up as big a retirement nest egg as possible. So let's dive into all that and more in the first part of this video. For our loyal subscribers and viewers, welcome back. We love you guys. And for those of you new to Diamond NestEgg, welcome to the #1 place to learn about money, insurance, and retirement. I'm Jennifer, first generation American. I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17 and graduated top of my class from NYU and Harvard Business School. And now I work on all things money with business owners as well as young professionals at places like Bloomberg, WeWork, and Marsh McLennan. So let's start at age 18. Set aside the maximum Roth IRA contribution limit of $6,000 every year. That's $500 per month or $16.44 per day. That's all, my future millionaire friend. Invest that money into the market for the long haul. Think along the lines of S&P 500 and similar indices and ETFs, which have had a historical average inflation-adjusted market rate of return of 7%. Don't think crypto, NFTs, and day trading for this long-term wealth building plan. Keep that money in there until age 65. Don't touch it. You'll have put in a total of $282,000 over the course of 47 years. But voila, there's your $2.2 million. Thank you, compound interest. Now, I have assumed that the maximum Roth IRA contribution limit stays at the current level of $6,000 per year, every year until my kids retire, which it won't. The $6,000 annual contribution limit will likely go up at some point as inflation goes up, meaning that this $2.2 million balance we've calculated here is actually on the low end. This $2.2 million, it's also tax-free because with a Roth IRA, you contribute with after-tax dollars. So the $282,000 here that you put in over the course of 47 years, you've already paid taxes on. The money that then grows in your Roth IRA is also tax-free. And that's why that $2.2 million nest egg you'll have in the end will also be tax-free when you withdraw it. Pretty neat, huh? Now, let's say you start a bit later at age 20. In this case, you'd contribute a total of $270,000 over a 45-year period, and you'd end up with $1.9 million. Start at age 25, and you contribute $240,000 over 40 years and end up with $1.3 million. Start at age 30, and you'd end up with about $900,000. As you can see, the later you start, the less your ending balance will be, which makes sense because your money has less time to compound in the market. If you start at age 45, you'd only have around $260,000. But still better late than never. Don't fret if you're a late starter. As the rules stand now, from age 50 and over, you can put in another $1,000 annually as a catch-up contribution. And the numbers I've shown you just now are specifically for Roth IRA. You can have other tax advantage accounts for retirement purposes. In addition to your Roth IRA, combine them in different ways, so to say. For example, you could also put money into a triple tax advantage health savings account, an HSA, if you have an HSA eligible high deductible health plan. The HSA's triple tax advantage comes from the fact that you can put money into it tax-free, the money in it grows tax-free, and the money that you pull out of it is also tax-free if you use it for qualified medical expenses. And these are just some of the HSA's benefits. The HSA wasn't created initially as a retirement planning tool, but that's what many folks are using it for, because let's face it, who wouldn't want to have a large bucket of tax-free money set aside for healthcare when retirement hits? Because those healthcare costs, they're skyrocketing. So let's say you do only start putting money into your Roth at age 45. As we've shown previously, you'd have about $260,000 by the time you're age 65. If you're eligible and able to open an HSA at the same time that you open your Roth IRA at age 45, and you contribute the maximum allowable amount to your HSA every year, like you do with your Roth, what would happen? For a single person, that maximum allowable amount is $3,650 in 2022, and for a family, it's $7,300. If you leave that HSA money invested in the same manner as your Roth IRA and waited until you turn 65 to withdraw it, you'd have an additional $158,000 to dip into for healthcare costs in retirement as a single person. Your combined Roth IRA and HSA ending balance, $418,000. Not bad when you put the different pieces together, huh? If we assume that you're contributing to your HSA as a family, that $158,000 ending HSA balance would shoot up to $317,000, bringing your combined Roth IRA and HSA balance to $577,000, more than $500,000 for you and your partner. And did I mention, it's all tax-free. Take a look at our HSA playlist here to learn more about HSA contribution limits, requirements, and the HSA loophole that folks in the know are using to turn their HSA into a secret retirement tool. The secret, which is becoming less and less of a secret every day though, given how much we talk about it on this channel. Now, let's say you throw your company 401k on top of what you have in your Roth IRA and HSA. Or perhaps you have another employer-sponsored retirement plan, like a 403b or 457. Do all three together, Roth IRA, HSA, and 401k, 403b, or 457. And even if you start at age 45, you'll end up with a nice chunk of change when you retire. Guys, retirement planning is not an easy task. There are a lot of different ways to craft the retirement portfolio that's right for you. So drop us a note at jennifer@diamondnestegg.com to see if we can give your retirement journey the boost it deserves. Well, that was exciting. So how much can you contribute to your Roth IRA and your company 401k in 2022? Some numbers have gone up, but some haven't. So let's take a look now at what's what. If you have a company-sponsored plan like a 401k, 403b, or 457, or a federally sponsored thrift savings plan, you can contribute up to $20,500 in 2022. That's a $1,000 increase from 2021. And if you're 50 or over, the catch-up contribution stays the same at $6,500. For IRAs, both Roth and traditional, the contribution limit for 2022 has stayed the same, unfortunately, at $6,000. It's kind of been stuck there since 2019, so at some point it will go up, just not in 2022. The catch-up contribution for 2022, if you're 50 or over, also stays the same at $1,000. There is some good news for Roth and traditional IRA holders though. But before we get into that, if you're enjoying this video so far or have learned something new, don't forget to give that thumbs up and subscribe button a gentle tap. Now, If you're new to IRAs, the simplest way to understand the difference between a Roth and a traditional IRA is that with a Roth, you pay your taxes now when you put your money into your Roth, but you don't pay taxes later when you withdraw that Roth money. With a traditional IRA, you don't pay taxes when you put your money in, but you do pay taxes when you take your money out in retirement. Take a look at our complete retirement playlist right here to learn more about the differences between a Roth and traditional IRA and which might be best suited for you. So, the good news for Roth and traditional IRA holders is this: the income ranges have gone up. Those of you with a Roth know that the amount you can contribute to your Roth is income-based. To be eligible for a Roth, your modified adjusted gross income must be less than $129,000 if you're single or head of household in 2022, $204,000 if you're married and filing jointly. If you're single or head of household, the income phase-out range is between $129,000 and $144,000. The income phase-out range refers to the fact that the amount you can contribute to a Roth is reduced at certain levels of income. If you're married and filing jointly, the income phase-out range is between $204,000 and $214,000. If you're married and filing separately, the phase-out range is between $0 and $10,000. This has not changed for 2022. If your income is above this income phase-out range, you can't contribute to a Roth at all. For 2022, if you're single or head of household, you cannot contribute anything to a Roth if your MAGI, your modified adjusted gross income, is more than $144,000. If you're married and filing jointly, that number is $214,000. If you're contributing to a traditional IRA, the tax deduction that you're allowed to take for your contribution is also gradually phased out if your income is above a certain level. Here are the phase-out ranges for 2022. If you're single and covered by a workplace retirement plan, the phase-out range is $68,000 to $78,000. For a married couple filing jointly, if the partner making the IRA contribution is covered by a workplace retirement plan, the phase-out range is $109,000 to $129,000. For a married couple filing jointly, if the partner making the IRA contribution is not covered by a workplace retirement plan and is married to someone who is covered, the phase-out range is $204,000 to $214,000. And if you're married filing a separate return and covered by a workplace retirement plan, your phase-out range stays the same at $0 to $10,000. This has not increased for 2022. Keep in mind that you have until the tax filing deadline of the following year to contribute to your IRA for the prior year, whether that's for traditional IRA or Roth IRA. This means that if you did not max out your 2021 IRA contribution limit of $6,000, you have until the 2022 tax deadline to do this. The tax deadline is typically April 15th. Remember, there are many paths to millionaire status. You can do it via a Roth IRA, a traditional IRA, an HSA, your company retirement plan, or a combination thereof. The options are truly bountiful. And if you need help figuring out the combo that best works for you, shoot us a note at jennifer@diamondnestic.com to see if we can give your financial journey, your retirement journey, the boost it deserves. Thanks for watching, guys. If you're still here, don't leave that thumbs up and subscribe button feeling unloved. We'll be back next week with another money-saving, wealth-building video just for you.